Hi, this is Hyperwave. I'm Leah Wald here with Tyler Jenks, and we've decided to kind of make it a theme to be a bit sillier on our shows. So, my shirt today says "True Story Bilbo," and oh man, that's happening. And Tyler, I'll just go straight to it. What's going on with your shirt over there?
Yeah, this is my fly fishing shirt. And it's got all these neat little things, places to put flies so you don't have to dig through your tackle and stuff. And it's got this great collar that keeps the sun off the back of your neck and keeps bugs off of your neck. And all kinds of these neat little pockets where
Good
you
one.
can hide all kinds of stuff. I do my best thinking when I'm fly fishing, so I'll pretend today I'm fly fishing.
Perfect, perfect. So, yeah, so we thought we'd be a bit silly, but so this one we were thinking, and just reading all your questions, all your comments, and they're brilliant, and I've always had a lot on my own as well. So I tried synthesizing as best as I could the questions that you guys have been asking, as well as the comments, and what we thought we'd do today, because hyperwave is at least for me as well, is very confusing on how to utilize it, and specifically from a trading perspective. So I'm going to be the student in the classroom, obviously an undergrad, 18-year-old hippie student, and ask Tyler sequentially questions. I think that will get more and more advanced, just starting with the basics. And, if you guys have any other questions, please throw them in the live chat that I may be missing. But hopefully by the end of this show, everybody will really get on the same page and will fully understand what is going on here with this hyperwave and how do we actionably utilize it. Now, Tyler has absolutely no idea what I'm going to throw his way, but he has his fly fishing shirt, and so he's ready to go, maybe to catch questions. Ooh, that was a bad one. That was a bad
Perfect.
one. Okay, so Tyler, is hyperwave a tool, a system, or a theory? How would you classify it?
It's clearly all three. The main thing to know about hyperwave is that it is a construction that occurs with the price of things, and it forms a pattern. There are many, many patterns. Leah knows because she's been reading Edwards and McGee, some of the original patterns that were recognized in price activity. Now, that sounds really highfalutin, price activity, but just stop for a second and think of what we're talking about. We're talking about two or more individuals, many millions sometimes, but two or more individuals that each have something. And all prices, forget the word price and all of that, just it is what the value is of something that one person has relative to what someone else has. If it's dollar bills and I have cans of soda, then the two of us can decide how many of those dollar bills will it take to buy how many of my cans of soda. That's the original idea of barter. But it has nothing to do with dollars or fiat currency. It has to do with the value of things and what people put on it. So just start there. So the question is, what is this particular pattern that's called a hyperwave? And what it is it's almost like a malignancy. It's almost like the people that are involved in that particular asset class, and that sounds highfalutin, an asset class. What we're talking about are things. We're talking about paintings or Chinese ceramics or rare coins that are called numismatics, or we're talking about shares of a company like General Motors or Netflix or GBTC, or we're talking about racehorses or racing cars or classical cars or suits of clothing or dresses, high couture. We're talking about things that people value in different ways. Now, there's groupthink, where we all agree in general about the general worth of something that sits around for a long time, so that many, many people have come to a conclusion that it's worth X, like gasoline for your car. I remember when you could buy gasoline for 50 cents a gallon, and then it went up to 75 cents, then $1, and then $2. And then everybody got frightened because of OPEC, because all of a sudden OPEC decided in the 1970s that they were going to stop providing the world with oil. So all of a sudden, that change in people's understanding of what something was valued shifted violently, and nobody knew how to price it. So what happens is people go through stages of trying to understand what the value of something is. And what a hyperwave does is it crystallizes that psychology. It crystallizes two extremes that are psychological. One is fear, the fear of not having something that you need. And the other is greed on the other side. Greed vanquishes fear until fear gets too great, and then fear vanquishes greed. So if you just start with that premise and just think in your own life about those things, houses are another thing. The whole crash in 07 and 08 and 09 wasn't just mortgages, it was also houses and housing. But the thing that caused it all was the 5 years leading up to that, which was a hyperwave. Because all of a sudden, the government made it very easy for mortgage companies and Fannie Mae and Ginnie Mae to loan enormous amounts of money with almost no credit checks on anyone. And the population ran wild because people that had owned homes for 10 or 20 or 50 or 100 years and was passed on, family homes that were passed on to sons and daughters and then granddaughters and grandsons, everybody realized there was something amazing about real estate. Not only did it go up in value over time, but you could use it. You could live in it. And what happened when those barriers to entry, putting down 20% or 30% or 40% for a house, vanished in 04, 05, 06, 07, it led to a total realignment of the way people valued real estate and the amount of risk they would take. They were able to overcome their fear of being too extended with the amount of income they had in their savings account. So people spent everything. They borrowed on one house to buy another house. They borrowed on that house to buy a third house. And it went rampant, and it went into a hyperwave. Now, one of the things I've stressed about hyperwaves from the beginning is it is a theory in that I have noticed over 40 years a bunch of these things happening. So I'm still trying to understand, why do they happen? Not that they happen. A lot of people don't believe there's a hyperwave. They don't believe in that thing that I call a hyperwave. I got beyond that a long time ago by studying many, 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 many of them and noticing there were great similarities between all of them. But what I've never been able to understand, and that's why it's a theory, is what is the reason behind it? why does that formation form? Why does it have 4 levels, phases 1, 2, 3, and 4 going up, and not 24? Show me something in which you can give me an example where you get angles going up over and over again, let's say by 5 degrees. And after a period of time, it goes up another 5 degrees and another 5 and another 5. And there's 20 of those things. I haven't seen a single one of those. I haven't seen a single one where there's 10. What I have seen in multitude examples is 7 simple steps. 1 flat, 3 up, 1 down, 1 up, and 1 down. Now, someday somebody will be able to put that together. Now, what were the other 2 terms that you used other than theory?
Yeah, sorry, I had myself on mute. Tool, system, or theory.
Yeah, it's all 3 of those. It's definitely a tool, but you need to understand what it is and how it works and get comfortable with the fact that they all have similarities, and then there are differences between them. If you only look at one, like in Bitcoin, you can become very confused. You need to look at 10 and 20 and 50 and 100, and then you'll see there's nothing confusing about it, and then you can use it as a tool. Then you don't doubt everything that happens. Then you're confident that 1 is followed by 2, 25% of the time, by 3, 85% of the time, by 4, 100% of the time, and then by 5, 6, and 7, 100% of the time. And once you know that and understand it, it is a powerful, powerful tool. It's a system, but the system is how you use that tool, and everybody's going to use it differently depending on what you understand about the theory behind it. So this is a long, rambling explanation, but it's going to set the tone for all the other questions we're going to get to. There are things called patterns that people began to recognize in price, patterns in price, going all the way back to the 13th century by looking at wheat prices. It's the longest series of data that we have on the price of one individual thing. We've got some idea of what happened in Greek and Roman times with their coinage, gold and silver coinage in subsequent years, but we don't have any precise information on it. But about 800 years ago, people began following wheat prices and keeping records of them. And so we've got a very long record that can be studied. Some people know that candlesticks come from Japanese rice farmers that needed a way to keep track of the price of rice. And so they came up with this technique that we now call candlesticks. Well, candlesticks form different formations, and they knew about it 200 years ago. We still use it today, and a candlestick can be a doji, and it can be a dragonfly, and it can be a hammer, and you can get 3 of them in a row that do a certain thing. Those are called patterns based on prices, based on looking at long periods of time. But it wasn't until the 1920s and the 1930s and 40s that some very brilliant people, many of which went either crazy or committed suicide, trying to understand how these patterns were developing. There was somebody called W.D. Gann, and if anybody knows anything about technical analysis, you might have looked into a thing called Gann angles. And Gann angles have to do with some observations he made about patterns that were made. Then we had R.N. Elliott back in the 1930s and the 40s that came up with this idea of Elliott waves. And they're still used today very, very effectively. All they are is they are patterns. Therefore, they can be used as tools. Therefore, when you put them together in a sequence where you understand what they mean and why, they become systems. And finally, you've got theories about why those systems work. And you need to consider all of those, but not to trade. To trade, you can simply use people that understand those systems, listen to them, watch them, evaluate for yourselves how effective these people are in interpreting the systems that they use. Tone Vays with the sequential system, Haijin Lee with the Elliott wave program, me with a hyperwave, with broadening tops, with consensio. Come up with your own, but it takes a lifetime. You have to be totally dedicated to understanding any one of these principles, but that doesn't mean everybody can't share and use them. And that's the way I am attempting with Leah to present Hyperwave as a tool for you to use. And I'm trying to take you step by step through how I use it, how I think about it. And people over time will fill in the gaps about the theory. I'm going to just say one other thing before we drop this subject, which is Fibonacci. The Fibonacci numbers come from what was called the golden mean 2,500 years ago. And it's simply the relationship of certain sizes of geometric figures, particularly rectangles, that can be divided up in such a way that all the parts of the divisions of that rectangle appear to be beautiful and appear mathematically to do a lot of things. That's why they called it the golden mean. Leonardo da Vinci understood all of that, and he used Fibonacci sequences and the golden mean in all of his sculptures, in all of his paintings, in all of his inventions. And that was 2,000 years, 1,500 years after someone came up with the observation of what a golden mean is. So when we get off of this show, those that are interested in the philosophy behind why patterns work, I would suggest to you to look up Fibonacci and read about it. Look up the golden mean and just do a quick cursory glance at W.D. Gann, G-A-N-N, and R.N. Elliott, E-L-L-I-O-T-T, and you'll begin to get a sense of what these patterns are all about and how they work and why. I've told you what the history of tone sequential system was, that it came from somebody named Larry Williams. It was picked up by somebody named Tom DeMark. Tom DeMark made some changes in it. It was picked up by Tone Vays. Tone Vays has made a number of brilliant changes to it. And you put all that together and you have got tools, you've got systems, and you have theories. So that's my short answer to what a hyperwave is.
Okay, Professor Jenks, one more. I'll even put on glasses to make this more official. Okay. So it seems easier to determine a hyperwave in an asset class retroactively. But if we believe that we have found a hyperwave that's past phase 3, how can we proactively use the hyperwave pattern?
Well, I've tried to be explicit on that, but I know it's hard to do. It's very easy to identify all 7 waves after they've happened. But after they've happened, you can't take any advantage of it other than to learn what a hyperwave looks like and how one particular one acted over time. If you're going to pick out a hyperwave, such as the NASDAQ hyperwave that we all have looked at many times if you've watched our show, and I can bring it up a little later, but I'm going to try not to get into charts and charting now. I'm assuming that the people listening to this have seen or heard at least one or two or three of our vlogs about hyperwaves. I know there are a bunch of people that have watched all of them, and that's where all these great questions are coming from. But basically, a hyperwave in the past is exactly the same as a hyperwave that is building right now, and will be exactly the same as a hyperwave that has not yet begun, that is in our future. That it's important to know that. It's important to understand that these don't change over time in terms of their structure. So I would throw the question back at you, the listener, by saying, how do you think you should use it? I've given you some numbers that something that goes flat for a period of time has about a 1 in 1,000 chance of becoming a hyperwave. But that is the definition of the first step in a hyperwave. It's called phase one. It's a horizontal line that restricts price for years. Well, am I going to do this now? Let me just think for a second. Yes, I am. I'm going to leave and come right back, and I want to show you a book.
Tyler.
Yeah.
Okay.
Too late.
All right. Well, you guys are stuck with me right now. Yeah, this I just geeked out pretty bad.
I am back with the book. This book says the 2009 SRC Green Book of 35-year charts. Costs about $300. I used to buy them every single year. What these are stock charts. And these stock charts are 30 years long. So you can go through every stock traded on the exchange and get a 30-year snapshot. And by doing that, you can pick out hyperwaves, past hyperwaves. But more importantly, you can see hundreds and hundreds and hundreds of examples of periods of time that might last 3, 4, 5, 6, 7 years where price can't get above a certain level. And that's a phase one of a hyperwave. So the question is, how do you use it? How do you tell when it's not in the past, but it's going on right now? That's step one. You cannot get a hyperwave unless you get that phase one flatness. Therefore, if there is no phase one flatness that lasts at least 3 or 4 years, it's not a hyperwave, regardless of what the price does, regardless if the price goes straight up or goes into angles. That doesn't matter. You need the phase one to build. But only if you find 1,000 of those in these books, or a ton of other books that you can get, if you're willing to take the time and spend the money and try to understand that, only one of them out of 1,000 is going to turn into a hyperwave. So I don't look at any of those. It's a waste of my time. But when I see a breakout of price above what looks like a phase one line, I start getting interested, because now 1 out of 4 of those is going to be a hyperwave. And by the way, I would buy every one of those 4, even though one of them is only going to work out. Why? Because the price has just broken out above a long horizontal trend line, and that means that the buyers have just swamped the sellers for the first time in years. And almost always, something that has that pattern is going to continue to increase in price. Therefore, it's a good investment, regardless of the fact that it might not become a hyperwave. You don't only have to buy hyperwaves, but when you're lucky enough to find one, now if it goes from a phase 2 to a phase 3, it becomes almost a certainty that you are about to make a lot of money. That's why you want to filter through as many as you can to see one of these things, because they're so valuable. It's like finding a diamond or finding gold walking along a stream bed, a nugget just sitting there. It's instantly valuable, instantly, as soon as you identify it. You don't want to wait for it to go phase 2, phase 3, phase 4, phase 5, phase 6. Oh my God, that was a hyperwave. You've lost out entirely. It's lost all of its potential value to you. So you look for a phase 1. You see that it's broken up into an angle less than 45 degrees that lasts a couple of years. That's phase 2. Now, if it breaks into phase 3, you know almost certainly that you are about to go on a ride. You're blindfolded on a roller coaster, but you feel yourself going higher and higher and higher. And not only that, you know that once phase 3 finishes, you're going to go almost vertical. Now, what are we talking about? We're talking about things that are going up between 8 and 40 or 50 times their original value. And they all do it. That's why it's so important to identify them. Unfortunately, they are so rare that you can go years without finding any of them. So again, as I said in the first podcast that Leah and I did, what brought me into the crypto space and Bitcoin was the recognition that I had found another hyperwave. So that is how you do it. You can now look at the many, many examples of NASDAQ stocks that you have found and I have talked about because of the NASDAQ that are in hyperwaves in various levels. Now, that probably means we're too late. Yeah, Leah.
Cool. I'm going to be the obnoxious student all the time.
Great.
So you use technical analysis on our shows and you draw lines in the charts, but it seems like the phase lines are different than the trend lines and the typical ways that traders utilize technical analysis. Can you comment on the differences and how we should think about your trading style of this?
Yeah, that is beginning to get into some great questions. And all hyperwave phase lines are trend lines. All of them are. But they're not readily apparent because either they occurred so long ago in terms of their earlier formation that people that drew in the first 2 contact points on a phase 2 or a phase 3 line, once those 2 are drawn in, they never change, regardless of what happens in the present or the future. Once you have drawn in those 2 points between the phases as you move from one phase to another, they do not change. Now, it is true that I have made some tiny changes in the Bitcoin phase 2 and phase 3 lines, but they are so small in terms of choosing one date over another date. They're usually a week apart, and the difference after a year is just dollars. I had one of our followers, ask me yesterday or the day before why his phase 3 numbers were different than mine today. And he said that it's true that they're only off by a couple of dollars, but what is the difference? So I went back and gave him the dates of my posting for the phase 3, and he was off by 1 day for whatever reason. And I've had other people that were off a lot more because they were using logarithmic lines rather than linear. And I've tried to explain that there are very, very few rules that I've come up with for Hyperwave, but two of the most important are, number one, that you only look at weekly closes on a linear chart. To construct your lines, to follow the lines, and to determine if a line is violated. Why? I don't know. But it works. And other things don't work with the same effectiveness. And I think that's true when you look at any of these patterns like Gann or Elliott or sequential. Why in sequential is a 9 important as opposed to an 8 or a 10? What's so special about 9? And you need to get back into Fibonacci numbers to understand the relationships between numbers and how patterns in nature evolve. So much of what happens in nature are relationships that relate to Fibonacci numbers. And when you go to a scientist, a botanist, and ask, why do sunflowers, the seeds in a sunflower, the relationship between the sizes of them as you get further and further from the center, why are all those Fibonacci relationships? There's no answer to that. Nautilus shells, when you cut them in half and you take a look at their chambers and you measure the size of the chambers, and remember who created that. It was a mollusk, a mindless mollusk that was secreting a mixture of sand and silicon to form the walls of the chambers. And when he was completed building this whole thing, the relationships were precisely Fibonacci numbers. So you talk to a ichthyologist and ask why, and they don't have the answers. So when you ask me why do weekly closes on a hyperwave system work, and why are there 7 phases and not 4 or 30, I don't have an answer. That's the theoretical part of it that people are going to have to work with. All I know is I've synthesized my use of these for 40 years down to the simplest rules that are the most effective. If I were you, I would ask the question, yes, but won't they change over time? And my response would be maybe. However, the golden rule is precisely the same as it was 2,500 years ago. And looking at Archimedes and looking at Galileo and looking at Copernicus and looking at Newton and looking at Einstein, things occur in nature and between people, which is this fear-greed spectrum that simply happens. And you can try to fight it and you can try to come up with alternatives, but then I think you have to go back to Occam's razor, which states basically the simplest answer is almost always the right answer. And that's why, to me, the rules in Hyperwave are as simple as they actually are.
Professor Tyler. Tone, I see that you just joined us. I'm a student here with Professor Tyler.
Yes.
Okay, so the next question. Can you use Hyperwave to make short-term trades, or is it only for long-term trading?
No, you cannot use it for anything other than what it gives you. And what it gives you can be a framework within which you should be making short or intermediate or long-term moves depending on your risk tolerance. What I mean by that is just picture a phase 3, forget phase 4 has not yet happened, phase 5, phase 6, phase 7 has not happened. But you know you're in a phase 3. You know 85% of the time it's going to keep going up into a 4. That gives you a huge clue. What I would do as a trader with whatever the asset was, the asset class was, that I identified in a phase 3 that had not yet accelerated into a phase 4 is every time that price got too far away above the phase 3 line, I would consider shorting it because I know it's going to return back down to that line. I would certainly, every time I saw price come down to a phase line, I would think very seriously about buying for a short-term trade because you get very large bounces off of the phase lines. We know now that even though Bitcoin went through a 1, 2, 3, 4, 5, 6, and 7, that it tried to hold the old phase 3 line 11 different times. That tells me that you had 11 chances on a short-term basis to put in a trade knowing that that line would be so resilient that it would keep bouncing off of it. Now, on the 11th time you did that, you would take a loss. But the previous 10 times you would have 10 gains. Then the question is, if you're going to try to use a long-term system for short-term trades, you better be very good at using stops. And if you bought every time Bitcoin dropped down to the phase 3 line and bought right off of that line and put a stop loss order below the line at such a point that you were comfortable taking that loss, you could have had 10 winning trades in a row, an 11th trade that didn't work out that you got stopped out of with a small loss. That's the way I would trade if I was trading hyperwaves.
What other indicators do you recommend that we use along with Hyperwave to time our trades?
Well, again, it depends on the length of the time you're making your trades. I like Consensio's theory and it as a tool because you can change the time of the moving averages. You need to understand how moving averages correlate to each other and react to each other and react to price. And forget about price. You forget about price, you just look at how they interact with each other. Once you know that, and we will get back to Consensio, we've just been so tied up with Bitcoin and cryptos that all we've been able to do is mention Consensio. But you can take long-term moving averages and you can sell when you get a death cross. You can buy when you get a golden cross. By changing the length of time of those moving averages, you can go from long-term trades. We looked at the gold trade and we saw that you could have made over a 15-year period just 3 trades using long-term moving averages and been successful on all 3 of those trades for an enormous profit from $265 up to $1,900 and then getting out of it as it dropped to $1,100 and now getting back into it. If you shorten those time periods, you can do the same thing weekly or monthly or daily by using that. And if you're overlaying that type of a system on top of Hyperwave, remember what Hyperwave I think of more architecturally than I do as a price pattern. because of the way it's structured with a strong foundation and then an angle going up and a stronger angle and a stronger angle. Anyone that knows about the mechanics of architecture and building understand what an arch is and why it's so powerful. Powerful in terms of the amount of weight that that arch will hold with two columns coming down from it, how the weight is dispersed because of that pattern, that particular pattern. The same with columns, Corinthian columns and Ionic columns and all of that sort of thing. All of those are building blocks to put something on top of. In hyperwave, phase one is the building block for something to be able to go up at a slight angle. That angle, if it goes long enough, becomes support for the next angle. The next angle, if it goes long enough, will support a skyrocket straight up, all of which will end. Everything in the material world, in the material universe, is limited. Mount Everest is not 60,000 feet high, it's 29,000 feet high. The Marianas Trench isn't 25 miles deep, it's 7 miles deep. There are limits to everything. And when a pattern of price goes to a limit, it will go no further. And we've got a way of measuring that. And by putting other systems like the sequential system, like moving averages, like Elliott wave on top of that framework, you can change your time perspective knowing that you've got this strong support below your decisions.
Professor, is that a Red Bull?
Yes, student.
Yeah, okay, thank you. It can be worrisome to draw these trend lines in fear that, or the phase lines, in fear that you're drawing them incorrectly. And especially given how quickly Bitcoin moves, it's difficult to try to wait out this longer time frame. You've mentioned recently that we are in a phase 7, yet we haven't broken down to the 4,000 line. So how should we be thinking about where we currently are and ensuring the fact that we are in a phase 7, you know, just quite blanketly, you know, how should we be thinking about where we are right now, and why should we believe you that we are in a phase 7?
Well, a phase 7 is not dependent on the extension of phase 2 or 3. A phase 7 comes about when a phase 4 ends. A phase 7 comes about when a phase 4 ends. And a phase 4 ends with a crash, which is called a phase 5. A phase 5 is a precursor to a phase 6. You can't get a phase 6 unless you get a 5. You can't get a 7 unless a 4 finally comes to an end and breaks. And as soon as a 4 breaks, you're in a 7. But you have to get there first. And a 7 can be thought of. You can think of a 4 as the composite of a 1, 2, and a 3. You must think of a 7 as a composite of a 1, 2, 3, 4, 5, and a 6. Now, the only time that does not mean that the 7 goes all the way back to below the 1 is if a phase 2 or a phase 3 line holds it up, making it a funky hyperwave. But you are in a 7 regardless. And if phase 3 doesn't hold it up, and phase 2 doesn't hold it up, you're going to end up below the phase 1 starting point. If the phase 3 holds up the 7 and stops it from going down, you can and we've seen one or two examples begin a new hyperwave and take out the old high. That's what I was hoping for with our phase 3, and it valiantly tried to do it for many months and finally failed. We have not come down to phase 2 yet, but we're still in 7. 7 is just blown through 3, and now it's got its sights on 2. So you are hoping, and I am hoping, that this will turn out to be a funky hyperwave in which either 3 or 2 stops the fall of 7 before it gets down to 1 again. And I have said repeatedly, I would not make that bet because it's so rare. It's true we found some. We found the NASDAQ. We've seen it in gold. But for every one that you find, I will show you 15 or 20 that never did it, where the 7 blew right through the 3, right through the 2, and ended up back below the 1. And then rarely, even when it gets back below the 1, you can go into another hyperwave, and we've shown you some examples of that. Yes?
Professor, you've mentioned previously when you've sold your positions from the perspective of a money manager, yet you're yet to mention if you've ever taken a short. Is there a reason that this hasn't been your strategy? Do you short utilizing Hyperwave, or what do you recommend for us traders?
I personally do short using hyperwaves, and I've done that for years and years and years. I never short for any clients ever, mainly because almost all of my clients, they are retirement accounts, and either you are not allowed to short in a retirement account, just like you are not allowed to put cryptocurrencies or Bitcoins long in a retirement account. All of the big pension funds, the IRAs, the 401ks, the 403bs, the 457s, the defined benefit plans, the defined contribution plans that I have managed for the last 25 years prohibit that. They also prohibit a lot of other things like penny stocks. They prohibit basically any stock under $5 a share. They prohibit options. They prohibit futures. Now, that's different than what I do personally. And yes, I short all the time personally, but I would never make a recommendation to short against a hyperwave unless you really know what you're doing and you understand it. You've got 2 wonderful points at which to short a hyperwave. One is on the breaking of phase 4 with a weekly close below the phase 4 line. That's a gift. What you don't know about phase 4 is how far does it drop before it goes up into phase 5. And I've seen a lot of people, and I have been caught myself, being short in phase 4 and all of a sudden getting an explosive phase 5 back up and losing all the gains as phase 5 took place. You will get another chance to go short when phase 5 is broken, when phase 6 is broken, which is an up phase into phase 7. Phase 7 is the best place to be short because it takes its time. It does not hurry. And a lot of the people have been asking, you said we're going to the phase 2 line at 4,000. Why aren't we there? It would not surprise me if we don't get there for a year. That's the way a phase 7 works. It could care less. It's just going to grind its way lower and lower and lower, which makes it a wonderful shorting opportunity. And those that are looking to fight a hyperwave in a phase 7, by looking for places to jump in because you get a big up day or a big up week, you are going to find yourself deeply disappointed because this formation called a hyperwave knows where it's going and it will take its time getting there, but it will get there.
So since funky, I do not know why this reverb is the worst. I guess because the classroom is so small here.
Yeah.
So since funky hyperwaves are so rare, why do you have the belief that Bitcoin may then turn into a funky hyperwave?
Because we've had 3 funky hyperwaves already in Bitcoin. And that's usually a pretty good clue that whatever this asset class is during this time period, it wants to go higher. There's a fundamental reason for it to go up. The problem is the ecosystem, the ecosphere, the traders at the various times. In the early years in 2012 and 2013 and 14, and now in 2017, which was such an unbelievable period, the traders did the same thing in each case, which is they took prices way further up than they had any right to be at that point in time. They crushed anybody that was short, and there were very few people short. It was manipulated, basically. And I don't mean that in a pejorative sense. I mean that when you have few players and they are all looking for the same thing, you will move the price in the direction you want until you've taken it too far and the fundamentals won't justify it anymore. And then you get this whole thing of everybody be quiet. Shh. No FUD. No fear. Nobody say anything. Nobody talk about how high it is, which is just plain silliness. The thing that moves prices up and down is based on principle and principles, and you can't tiptoe around those principles. Your question was, why do I think, did I think at phase 3 this might go into a funky hyperwave, and why do I still believe it could at 2? And that's because I really believe in this asset class and its potential, number 1. Number 2 is because it has shown that tendency before. Number 3 is we have had such an enormous move in such a short time period, the biggest I have ever seen for any hyperwave I've ever studied, that it tells me that this thing is legitimate, at least relative to people's belief systems. And until that gets crushed, I think it will keep coming back and keep coming back. The question is when and from what level. And that's what a technical analyst needs to focus on, not the fundamentals where there are so few in something like Bitcoin.
Second Stephen has decided to join us back there. Okay. What? This reverb is killing me. Okay. Even when you have a belief that a hyperwave is in a certain wave and you want to take a position, how do you know when to enter and exit from just the minutia of trading?
Well, you want to buy, you want to sell a phase 1 when the price gets up to that line. You want to buy a phase 2 when the price gets down to that line. You want to buy a phase 3 when the price gets down to that line, and a phase 4. You have to decide how far above the lines you are willing to let it go before you take profits. Or in phase 1, you've got to decide how far below phase 1 it drops before you want to take your profits. And that's up to you. But the perfect place to buy them or to sell them is you buy them when they are an up phase and you have come down to the line, and you sell them when they break that line or when the price comes up to overhead resistance on a line like a phase 5. A phase 5 is a down line. Therefore, when you have dropped way below that, if it comes back up to it, that is a perfect place to sell it again. Same with the phase 7. You want to sell when you come up to the phase 7 line. You don't want to guess that it's going to break that line and buy it, because the phase 7 line is in its completing last final stages.
So with the traditional market, we do take fundamentals into account with our trading, even as technical analysts. Yet, obviously, it's quite different in the crypto world. Do you still utilize certain fundamental analysis when you're thinking about your trades within this hyperwave pattern?
Yeah, absolutely. The best thing for an investor to do is to use as many tools and techniques as they're comfortable with, and not be afraid that some of them are going to give you information that others aren't giving you. Yesterday, Leah and I did a brief piece where we looked at 7 or 8 different systems in which I concluded that one of them was bearish, one of them was neutral, and all of the others were negative. I'm sorry, one bullish, one neutral, and all of the other were negative. But I wanted to look at all of them, because if that begins to shift, Hyperwave is one of them, moving averages is another, stop and reverse was another, Fibonacci was another, MACD was another, horizontal trend lines were another. If you go from 7 being negative, you are silly if you are not taking the advice of those 7, if you're confident in how to use those 7. If you've got 5 that are negative, 1 that is positive, and 1 that is neutral, you should certainly have a negative bias in your trading. But over time, if that begins to shift to only 3 that are negative, 3 that are positive, and 1 is neutral, you better be getting neutral in your trading. Now, it's true, and I love it on Tone's cover page on trading, he shows the example of somebody that's using 8,000 different lines that nobody in the world, a supercomputer could take that information in, but individuals can't and shouldn't, because you'll just confuse yourself. So you have to get comfortable with a system, understand that system, not go by the person that knows the system and is telling you what they believe. If this is your money, it's not my money, it's not Tone's money or anyone else's, it's yours. You must be comfortable that you understand the system that is being described. And if you aren't comfortable with it, go find one you are. If you are too lazy to really explore technical analysis and try to understand these various systems, either lazy or you don't have the time, or you believe the fundamentals that you know are going to take you to where you want to go, so you don't need any of these tools, then that's your decision. The most effective traders, the best investors I have ever met, are those that use a number of technical systems on top of fundamental analysis to come to a final conclusion of what they're going to do. And everybody will come to their own sense of comfort about making those decisions. And then you know you're a true investor.
Do you always fully exit your position, or I'm going to get rid of this. Or do you, microphone's going to kill me. How do you liquidate your positions?
I, like everybody else, I find myself in the wrong positions for whatever the reason, and I blow out that trade. And that's the worst thing you can do. You shouldn't have let it get to that point. You should have been, and it meant you weren't keeping on top of the trade. The right way to get into or out of a position is to step into it as information begins to show you the probability is increasing that you are correct in a purchase. So you can do it what Hyjin Lee calls layering. Tone gave a very good discussion today about shorting Bitcoin or other cryptos off of the current status by taking a 1/4 position if X happens, another 1/4 position giving you a half a position if Y happens, and another quarter and another quarter until you're fully in. But you need to describe at what point you're going to do that. And you've got to understand why you're doing it, because the probability is increasing that that trade is in the right direction. And you're getting more information as every subtick takes place. By subtick, what I mean is I trade Hyperwave on a weekly closing basis. But a week is made up in Bitcoin land of 7 days. In stock land, it's 5 days. So a week in the stock market, if I'm trading on a weekly basis, every day that builds that 5-day period gives me more information. On Bitcoin, every day right up till 8 o'clock on Sunday night gives you information. So what you do is you tactically figure out if this happens. You don't tell yourself it's going to happen. You don't assume it's going to happen. You say, if it happens, then I am willing to do X. The biggest thing with taking a position is what is the total position you're willing to take. I will never put any of my clients into more than 10% into cryptocurrency and Bitcoin. So when I say I take a 25% position, I mean 25% of 10% or 2.5%. So when I talk about GBTC, I will pick points and I will put in 1/4 of a position, another quarter, and now if the evidence begins to turn against me, I get out of that second quarter and I'm back down to 1/4. If it goes back up again, I put it back on. If it goes up again, I will have 3/4. And if everything falls in place eventually with I thought what was going to happen, I've got a full position in. Same thing on the downside or getting out of a position. That's the right way to do it. It's time consuming. You have to think. You've got to think ahead, and then you've got to follow what the market's actually doing. It does not help to have a plan, no matter what tools you're using, if you go 3 or 4 or 5 days or a week without checking exactly where you are in that plan. If you don't have the time to do that, then you shouldn't be trading it. You should be looking at longer term perspectives that you can follow.
Do you trade on the CME CBOE? And if not, why not?
I do not trade
Bitcoin.
now cryptocurrencies or Bitcoin because I'm out of the market. I got out of the market when those were implemented in December, and I have not been back in the market since, except 1/4 of a position for clients in GBTC. I have traded extensively on the futures market and all the option markets and all the futures markets before they all consolidated for 40 years. I've created hedge funds made up of ETFs. I've created a trading system called the Selgin trading system. It traded 42 different commodities on 10 different commodity exchanges. Every single day, we were either long or short. And that was using what I pointed out a week ago called the broadening top, which is where we are right now on the NASDAQ. That formation called a broadening top appears very frequently in the commodity markets. And so we built a system that traded that across all the various futures exchanges, either long or short, on every one of those commodities every single day. So yes, I know futures and I know commodities and I know options backwards and forwards. I do not use any of them for clients. All my clientele are the portion of money that individuals or institutions have that has a 10, 15, 20, 25-year time frame. And I don't take risks with that money. What I do is I am aligning clients' accounts with the direction of the major indexes. And then I trade around that through the various sectors in the economy and the markets by overweighting or underweighting. Or if I see something really bad beginning to happen, I raise cash or I put on inverse positions to protect the positions we have. All of everything I just said is very different than what we're talking about in the crypto space, which is pure speculation, pure short-term movements. But we're trying to use some long-term strategies to be able to muzzle or thwart the dangers of that type of a market, this type of an asset class.
Given that we're all coming from different trading backgrounds, like me from a fundamentals, is there a good way for us to all start understanding Hyperwave, you know, from an elementary level where we can maybe find some sort of camaraderie within certain technical tools? Maybe what are those technical systems and tools where we can begin to start charting and also trading accordingly?
Yeah, Hyperwave as a system is not going to change, and it's very simple. So you just need to learn that system, then figure out how you are going to fit within it rather than making it fit within your trading. That's very different than sequential or Elliott or GAN or almost any other trading system. You've probably, those of you that follow Haijin Lee, when he talks about we are in a corrective phase and he does not have any idea what that phase is going to look like or what that corrective portion of the Elliott wave is going to look like, because there's 36 possible combinations of what is about to happen. And then he will take his best stab at his primary evaluation and then give you a secondary and sometimes a tertiary evaluation going forward. But then consistently has to change all three of those, because they weren't the three of the 36 that price actually did. So there's constant change within Elliott wave. There's constant change within sequential. There is not constant change with Hyperwave. Just learn the 7 basic steps and know that they are not short-term ever. They're not even intermediate term ever. Sometimes you get something like Bitcoin that is so active that you can get a short phase 2 and a phase 3, going into a very quick 4, 5, and 6, but it's taken 10 years to go through that whole process. So the most important thing I can tell you tonight about Hyperwave is, number one, don't sell it short. Don't look for, don't amplify small variations that make you feel as if the entire structure is not really as strong as it is. I can't persuade you on that. You're going to have to convince yourself of that. And one of the things Leah and I will start doing is we're going to start holding full day seminars, teaching all the details of Hyperwave with all the examples that we've got and pointing out a bunch of other differences and similarities that we simply haven't had time to do in 30-minute or 1-hour increments or quick tweets, so that you can ask questions, we can go into details, we can argue about points, we can talk about the theory and the strategy. We don't have a schedule for that yet, but we will be doing that. And then we will be tying it in with a number of these other systems like Consensio and the Selgin trading system and the broadening top program, and how they all work with all these other systems that you might have learned or seen from other people. This will be all about some of these proprietary original systems, how I use it, examples of when I have used it, what has gone wrong, what has gone right, and why and how. But that'll be coming up at a later time.
Well, I think that's it, Professor. Do you have any homework for us?
Well, those were all great, incisive questions. I've asked them all myself over the years, and I think everybody's got to go through that process. There aren't any shortcuts with this. The thing about it is once you are in it, a lot of things very good can happen. It can get you out of a lot of trouble, like getting you persuaded that hodling doesn't make sense if you know and believe that there is a hyperwave in the asset class that you have decided to buy and hold. Hodling didn't come from Bitcoin or cryptocurrencies. It is the oldest thing on Wall Street. It's called buying and holding. Vanguard's John Bogle has preached it for 50 years. Don't trade. Get an asset class you have confidence in and buy and hold it. The gold bugs for the last 40 years have said, don't get out of your gold. Don't get out of your silver. Bad things are about to happen. And they went for years and years and decades without getting any return on their investment. I am not a believer in any asset class of buying and holding. It simply doesn't make any sense to me, because I know that everything that goes up will come down at some point. And if you are smart enough to know when that point is going to be, then you can do it. And I've never met anyone that was capable of doing that. You need to understand that there are times to be in and times to be out of every asset class. Don't tell me what to buy. Tell me when to buy it.
That's good. I think people get a little upset at us when we discuss hodling and trading with hodling. But yeah, just as a follow-up point on that, philosophically, I think that Tyler and I agree that if we believe that hodling is the belief that Bitcoin will rise in price and value in the future, then we are hodlers. The question is, when. And if we're looking at hyperwave, that could be many years from now. But that doesn't mean that in the meantime and every week and every month and every, continually seeing these trends and looking at the price action and understanding hyperwave and Consensio and all these other tools, looking for when you hit the bottom and when you believe it's going to go back up, and following these trading methods to therefore buy back in and hold until the appropriate timing. So it's not that we don't believe in Bitcoin and Bitcoin strength and Bitcoin being king and Bitcoin lasting and whatever Bitcoin may turn into in the future. It's just simply trading and trading strategy. But Tyler, comment on that one?
Yeah, that's exactly right, Leah. And it brings up another important point. We won't talk about it today, but we've had so many questions asking us to get into the macroeconomics of gold, Bitcoin, interest rates, fiat currency, and how they all play in together with my view and some of the comments I've made that I believe there's only two solutions to the macroeconomic problem of credit and too much debt. And that is either going back to a gold standard or having Bitcoin actually become a workable replacement for fiat currency, which it is not now, but has all the potential to be. None of the other cryptocurrencies in my mind have that potential. So there's a great interplay between interest rates, inflation, gold, and Bitcoin, and we will do a whole show on that. But it goes right along with what Leah just concluded, which was this is the most exciting asset class that I have participated in. And believe me, I have participated in a lot more than I wish I had. I have a curious mind about asset classes, and so I tend to go whole hog into them. Numismatics is one of them. I am an expert on rare coins. I have built rare coin collections, and I wish I hadn't, because I learned a lot about that entire asset class that is not very good. And it is also true with art, and it's also true with racehorses, particularly with racehorses, and a lot of other things that people consider to be investment. I participated in all of them at various times. And the one that stands out to me is this one that we're talking about now. And the fact that I have the confluence of an asset class that I absolutely love and respect and believe is going to do great things, and a system that I love and respect and understand, that I can fit on top of that to help guide myself and other people through what has been a difficult period for the cryptos. And there very well might be others in front of us. I do believe that most of the others will disappear. I don't believe that this one will.
Fantastic. Well, everybody, thank you so much. Tyler, I am going to go crazy with this microphone. If we don't have any homework, is class released?
Almost. We need some more answers on Consensio. I will give you a hint. We've got 3 or 4 people that have correctly calculated that a price in 3 moving averages has over 1,000 combinations. Not 36 or 72 or 100 or 200, but over 1,000. But for those that want to go down that trail a little further, we will be doing a lot more Consensio in the next 2 or 3 weeks. Thank you very much for listening. It's been a lot of fun. Thank you, Leah, for those great questions.
Thank you, everybody. Until next time.
Bye-bye.